Welcome back to my YouTube channel, Victory Reverse Mortgage. I'm Benny Victory. This is the big grand finale. This is what all the videos that I've been talking about and going through the benefits of the mortgage insurance premium and saying that there's a cost associated. This is the video where we talk about the formula, about the cost. And if you recall the first video that I started this series with, I said that in the absence of a value proposition about what the reverse mortgage can do, about what the mortgage insurance premium is able to offer in the way of premium, the idea of the cost is really in a vacuum. It makes no sense. And that's why I said a lot of these videos that are in the echo chamber that talk about reverse mortgage costs make no sense, because they don't take that cost conversation and make it relevant. They don't make it relevant to the features and benefits of the reverse mortgage. They don't make it relevant in terms of what the actual cost is in terms of dollars. They don't make it relative to where that money is coming from and giving the impression that the borrower has to come out of pocket. And in the previous videos that I've discussed the benefits and features of not only just the reverse mortgage, but the mortgage insurance premium, we said and established that the biggest reason that it exists is in the case of the senior who's living in the house and not obligated to pay a mandatory monthly payment, being faced in a situation where a lot of families were back in 2008, 2009, all the way to 2012, when the property values declined significantly and the home value was actually below what the loan amount was. So we had a situation where you had a loan amount of $600,000, but properties declined to come to be $500,000. And a lot of families walked away from the mortgage obligation or did a short sale. And unbeknownst to them, the lender had the legal protection to come after them and get a deficiency judgment. And the reason the mortgage insurance is in place was my contention that the reason the mortgage insurance is in place is because of the fact that FHA requires it to avoid exactly that type of a scenario. So in this video, what we're going to do is we're going to actually do the math and calculate what the cost is, where the cost comes from, and go back and kind of wrap everything up and say in a kind of a bigger picture why you want to have the reverse mortgage going into place. Because you might think that the option for you is the option that you have right now, which is staying with your current traditional monthly mortgage payment and just running that out till the end and having the house be free and clear. If that's what you're thinking, if that's what your game plan is, then this is the video for you to watch and to kind of have some of the concerns that I have and some of the video series that I've done specifically talking about what the Consumer Financial Protection Bureau discovered through its census, that 682,400 seniors as of July 2021 are now delinquent with their monthly mortgage payments, and another 83,000 of them age 65 and older are facing foreclosure. So the question is why were those people in that position? And if you're thinking that you're not one of them, I respectfully disagree and say that as long as you have to make a monthly mortgage until your loan is fully paid off, you're not out of this danger zone. But for what we want to talk about right now is we want to talk about the MIP conversation and its cost. We've already established that MIP is an FHA requirement. And the way it helps is that it protects both the lender as well as the borrower's estate, and the borrower's heirs. And we already established in the previous video that it protects the borrower, their estate, and their heirs against short sales and deficiency judgments. And we just established what deficiency judgments is. It's a scenario whereby the property values through a decline of the real estate market appreciation, housing wealth, it drops below what the balance of the mortgage is. And if you're thinking that this is strictly a reverse mortgage issue, the reason you're wrong, respectfully, is because of the fact that back in 2008, 2009, the people that fell short and had to go through the short sale, these were not people that had reverse mortgages. These were people that were making the monthly mortgage payments. And if you understand that monthly mortgage payments, the way they're designed to do a very minimal principal reduction, and it's not till year 20 and on that the majority of your payment that you're paying is principal reduction, then you can see that you're really at the mercy of the housing market either going up or coming down. And those are not things that are in your control. And my contention is that I keep going back to is that as a senior, you're entering a phase in your life that for the next 10, 15, 20 years, you and your spouse are going to have housing security and need to not worry about what the real estate market is going to do. Because if the market goes down 20, 30% and your house is worth $1 million, you just lost $300,000 of housing wealth equity appreciation without doing anything. You just happen to be at the wrong market. And if you've had your house for 20, 30, 40 years, how many real estate cycles do you remember going through where exactly the housing depreciation I'm describing happened? And then how long did it take for that housing wealth appreciation to slowly, gradually come up again? Now, at your age, with, God forbid, the loss of a spouse and losing their monthly income and having a monthly mortgage payment, do you want to take that risk where housing values decline and your income, your fixed monthly income, declines along with it? And then even if you want to bail, even if you want to sell the property, you can't because now you suddenly have a significant equity loss in the home. And that's what the reverse mortgage conversation is all about. The reverse mortgage conversation has to do with giving you flexibility, financial independence, freedom. And that's why I say, if you look at the other videos that I've done in my playlist, I've now covered the objections that as a prospective person who's interested in getting a reverse mortgage, you will most likely have. We are now finishing up the cost conversation, but I've dealt with the conversation of the reverse mortgages being an equity stripper and not leaving any money left behind so that I don't have anything to give back to my heirs. Leaving the conversation of not having the bank be on the mortgage or on the loan and losing the house because you think that you're going to be off title. All the big objections that you may have that I've seen typically come up, I've addressed from different perspectives, and I've also addressed the different concerns that I have for you that you may have not even considered. How are you going to qualify for another mortgage when you're 85 years old, regardless of the fact that you have excellent credit and your house is worth $1 million and it's paid for free and clear when you're on a fixed monthly income? If you watch those series of videos, then you understand that you're not going to be qualified for a traditional mortgage. The fact that you're at risk and exposure to foreclosure because you have a traditional mortgage. Well, why do I make that contention? Well, there's in my playlist 3 videos that back that up. Why don't you have to make a monthly mortgage payment with a reverse mortgage? There's a whole host of videos around that. If you're watching the YouTube videos and you're listening to these unlicensed, uneducated people that are just making videos for the sake of making videos to get hits, and they're saying that the reverse mortgage is a scam. Well, there's a whole playlist that I've done about reverse mortgages and the contention that they're a scam. So I'm making these videos and the library bigger and bigger and bigger so that from every aspect that you can think of and some that you haven't think of or thought of, to use proper grammar, you're covered. And to this point, I want to just take a moment before I just dive in. I got a very kind comment on the video that I'm doing, the video series that I'm doing regarding the cost that I want to share with you. And this is what makes me be here. Today is obviously you don't know what it is, but today is Friday, December 30th. tomorrow night is New Year's Eve, and I'm here in the office at 6 o'clock right now making this video so that I could post it and hopefully this year make a difference to some seniors in their decision and in their thinking. And the reason I do it is I want you to just listen for a second before I get back to this video. This is from a gentleman that commented on my cost versus benefits video. His name is Ronald. As a recent recipient of a reverse mortgage, I can fully attest to the accuracy and credibility of information conveyed in your presentation. Additionally, I'm very appreciative of the methods used in your series of videos as a constructive medium of instruction and communication. I sincerely hope that the prospective reverse mortgage borrowers will benefit towards determining if this somewhat complicated financial product is right for them. Thank you. Thank you, Ronald. I know that this video is going to help some people, and my intent in all of these videos is to help you and your financial advisors and your adult children to help you make the financial decision that is best for your retirement. And I know that the topic has a lot of negativity around it, and that's why I try to really go deep and look from different perspectives on every topic that I could come up with. And I really appreciate that comment, because it makes me feel that I'm making a difference to some people. Even though I wasn't able to help that gentleman, he now feels better for the fact that he's got a product that he knows is going to help him through his retirement, and that's what I want for you. So now we're talking about this black box of what the cost is, because the cost conversation is one that makes people run for the doors and dissuades them, possibly because nobody's ever unraveled the curtain and pulled it back and said, what are we talking about? Well, we left off that the short sale and the deficiency is what we're protecting the borrower, their estate, and the heirs from, and giving the lender the sense of financial security that they need in being able to do the reverse mortgage. The money that's collected for paying FHA is used to purchase the insurance, the MIP insurance, through the Mutual Mortgage Insurance Fund. And that's an actual governmental agency, FHA, that makes the purchase on behalf of the insurance. Now the question becomes, what does it cost? And this cost conversation, I know it can get a little complicated, but I'm going to do my best to break it down to make it as simple as possible for you. So we have two sides. We have the appraisal value that's less than 1 million, and we have appraisal values that are over 1 million. So we have less than 1 million, we have over 1 million. And if you think about it in terms of the MIP premium is calculated at 2% of either the over $1 million or less than $1 million. The good news is that if it's over $1 million, there's a maximum limit. And the maximum limit for going into 2023, which is in 2 days, is $1,089,300. So this $1,089,300 at 2% creates a loan fee of $21,786. Now I know saying that mortgage insurance costs $21,786 seems enormous, and I'm not discounting it and I'm not disregarding it in the sense that it's a minimal amount. But what we started off with, the first video that we did in the cost series, is that we need to give perspective, we need to give proper reference in terms of what it is. So first I just want to rule out the math. So what does this mean? That means that if we appraised your house and your house is worth $1.5 million, well, $1.5 million at 2% is $30,000. But this is a cap. This $1,089,300 is a cap on the higher priced properties. So if your property is worth 1.1 million, 1.2 million, 2 million, 2.5 million, it doesn't matter. Anything over this amount of $1,089,300, the amount is going to be the same. It's going to be this $21,786. So that's on the 1.1 million and over properties. The cutoff is the $21,786. Now on property values that are worth less than 1 million, well, we just do the math. If it's 1 million at 2%, it's $20,000. If your property is worth $900,000 at 2%, that's $18,000. If your property is worth $800,000 at 2%, that's $16,000. If your property is worth $700,000 at 2%, that's $14,000. And these figures that I'm giving you for the mortgage insurance, it's not like you're going to come into escrow or somebody's going to ask you to write a check and give us a check for $14,000, $18,000, or $21,786. I'm making the point that, my contention has been, your property value accumulation, your housing wealth is what's paying for this mortgage insurance. And I could, put that point to the test, because here you could look at a continuum. This is when you purchased your property, and I'm going to use the example of $200,000. And I'm going to say that in the course of, depending on where your property is, what area it is, how big your property is, those factors that are unique to each property, you can understand that over the 20, 30, 40 years of home ownership, your purchased property, which was $200,000, I'm using the example of $1 million. In other words, what you've had over the course of your home ownership is that you've had this property value appreciation, what I call a housing wealth, which had nothing to do with what? Paying down your loan amount. Yes, you paid your loan amount. That's your mandatory loan obligation. You've been paying your monthly principal and interest payment, and that's been gradually reducing your interest balance and your principal loan amount. But this housing wealth, this big $800,000 that we're talking about, okay, this came as a byproduct of you staying in the house for the last 20, 30, 40 years and getting your housing wealth to reach $1 million. And what we're talking about now is being able to say, this $800,000 that is my housing appreciation, I'm going to tap into it based on where I'm at in this age spectrum. So at age 62, the senior is eligible to start applying for reverse mortgage. And I have a glide path going from 62 till 100. And again, it's up to 100 because I'm not saying somebody's going to come in at age 95 to get a reverse mortgage. But if you get a reverse mortgage at age 75, at age 80, okay, then the question becomes the likelihood of you staying in the same house, aging in your own house in place, for how long? Well, those are determined by how healthy you are, what your needs are, whether the property is safe for you, whether it's comfortable for you to continue to stay there. But let's say, for example, you're in a position where at 75 you get the reverse mortgage, at 80 you get this mortgage, and you're moving forward. For the next 10 years, you could be in this house, pay off your existing mortgage if you have a traditional mortgage, and age in place and not have to make a monthly mortgage payment. And when I flip this board and we go to the other side, we could pick up that idea. But the cost of paying this mortgage insurance premium, which is what we're talking about right here, the cost of it, if your property is worth, let's say, $1.2 million, so you fall into this maximum loan amount, MIP of $21,786, this is a fraction of your this $21,000 is a fraction of your $800,000 overall housing appreciation. And that's why I'm saying it's a It's an insurance protection, just like your traditional homeowner's insurance protection that you do pay for every year for the past 20, 30, 40 years. And if you remember in the last video and the video prior to that, what I said is that the reason you're required to have the traditional homeowner's insurance is to protect the lender. And this MIP is exactly the same idea. The MIP also protects the lender. Your homeowner's insurance protects you. This mortgage insurance also protects you, your estate, and your heirs. The difference with your homeowner's insurance is that you have to pay the premium out of pocket. Here, you don't have to pay this premium out of pocket. In your homeowner's insurance, it protects you against fire, theft, damage to the property, and protects the lender. Here, this mortgage insurance is the backbone, is the very reason that the lender is even willing to do a reverse mortgage, because no monthly mortgage payment is required. So we have broken down what the cost is, and if you accept my contention that it's your housing wealth, it's your housing appreciation that pays for it, then the question becomes, well, is it worth it? Is it worth for me to have a starting balance of $21,000, $22,000 when I get this mortgage insurance? Because even though I don't come out of pocket, it's a balance that's on my mortgage, and at some point somebody's going to have to pay for it. And I get that, because just by saying it doesn't come out of pocket, it doesn't make it disappear. So then it becomes, do we have a proper value cost benefit proposition? Do we have a value to having a reverse mortgage that requires you through FHA to have this mortgage insurance and for you to have a starting balance of $21,000? And that's this second part of the presentation. And my argument is, you be the judge. In the first video that I rolled out about the overall cost approach, I said to you that if you and I were to meet and you didn't know me and the fact that I do reverse mortgages for seniors exclusively, and I said to you, I was able to help my parents get a mortgage, and these are the features and benefits of the reverse mortgage, and I were to discuss them with you, and I said to you that in the mortgage that I got my parents, I was able to pay off their existing mortgage balance. And you're like, well, there's nothing special about that. Anytime there's a refinance, one bank pays off the old balance. But I would have said, but when I paid off my parents' existing mortgage, I freed up their monthly mortgage payment to be able to use towards something else. In other words, if they were obligated to pay the monthly $2,000 payments, in the mortgage that I got them, now they have this $2,000 to do something else with and not have to pay the bank on a monthly basis. The other thing I was able to do is, by them not having to pay mandatory monthly payments, I was able to extend their reserves and their savings, because now their limited savings and reserves could be used for other expenses. In addition, I was able to reduce or completely eliminate my parents' risks for being in a foreclosure, because foreclosure comes as a byproduct of the senior not running into a situation where they're out of money. So if you go back and you see some of the videos that we've done where we talked about, there's a report now by the Consumer Financial Protection Bureau through the census that they've done as of July 2021, there's 682,400 seniors that are now delinquent in their monthly mortgage payment, and another 83,000 that are facing foreclosure. These numbers came about as a byproduct of the fact that these seniors couldn't reduce or eliminate their foreclosure risk. They ran out of money. They made every payment that they could until they ran out of money, and then they couldn't make a payment anymore, and they still were obligated to pay the monthly mortgage payment. So in the mortgage that I got my parents, I was able to reduce or eliminate their foreclosure, because now my parents only have to pay what? property taxes, homeowners insurance, and maintain the property. And those are things that you're going to have to do regardless of if you have a traditional mortgage or if you have no mortgage at all. Even if you don't have a mortgage, you're not going to have your biggest asset be unprotected without having homeowners insurance. What else was I able to do? Well, I was able to provide housing security for both my parents for life, because as long as they live in the house and they're paying these required taxes and insurance and maintaining the property, they could live in that house till they're 100 years old, 105 years old, and nobody's going to come knocking on the door and say, you didn't pay your monthly mortgage payment. Because of the home equity that they had and because of their small balance, I was also able to get them an established line of credit. And that line of credit came along with some other features and benefits that a traditional home equity line of credit, or HELOC, doesn't have. And the reverse mortgage HELOC that I got my parents has a growth factor so that the unused portion of the reverse mortgage can grow and increase, and over time my mom could use it if she wants to use it. And that line of credit that I'm talking about can't be reduced, closed, or frozen by the bank, which is different than a traditional HELOC, which can be reduced, closed, or frozen. And that's what happened in 2008 through 2012. And obviously, the biggest factor is on the reverse mortgage line of credit, just like on the traditional aspect of it, the line of credit and the reverse mortgage itself, there's no monthly mortgage payments that are mandatory. And in the event one partner passes away, then that reduced income, which can traditionally put a person in a risk for foreclosure because half the income is gone, with a reverse mortgage, the loss of the monthly income from a spouse is not going to affect their ability to pay the monthly mortgage payment. So now the question becomes, is there enough value proposition to that all rounded up to $22,000 in case your property value is over 1.1 million, or if your property is worth $700,000 and at 2% that's $14,000. Now the question is that what are you getting for that money, and is it worth it? On a traditional loan that you're familiar with, you get a loan amount. Okay, let's say you get a loan amount for $400,000. Okay. And you have a 30-year period, and you're obligated over 30 years by making principal and interest payments to continuously make these payments until you reach 30 years, and then the balance is zero, and then now you own the house free and clear. But we've talked about in other videos where every time the interest rates came down and property values came up, most people refinanced. And this cycle over the 20, 30, 40 years of ownership that you've had kept occurring. So it kept pushing you out. So here we have a 30-year span, but underneath it, we also have the realistic situation of where you are in your life. When you first traditionally got this mortgage, you were working, you were full-time employed, you were making money, and you had income that you needed to shelter the income, and the interest portion of principal and interest was offset against your employment income. So you made $150,000 and you were needing these interest deductions to offset your employment income, and it made sense for you to be able to do this cycle over again. Well, at some point you went into retirement, or at some point you got the last mortgage that you're in now. And that's the point that I want you to think about. When is the last loan that you got that you're in right now? The traditional mortgage that you have, when is it? How much do you owe on it? And how old were you when you got it? And how old are you now? So this is my senior. This is you. This is you right now. And in this example, what I'm making is I'm using two figures. The figure in the above says that the senior at age 55 is when they got this loan, this last loan that they're in. So that 5 years into the loan, they're age 60. 10 years into the loan, they're age 65. 20 years into the loan, they're age 75. 25 years into the loan, they're age 80. Now, if you're saying, no, 55 is too old, I was 50 when I got it, okay, well, we've got you covered in the bottom. So if you got the loan when you were 50, 10 years into it, now you're 60. 20 years into it, okay, now you're age 70. 25 years into it, you're age 75. Now, let me ask you this. You're either age 70 or 75 or older, and you still haven't paid off your mortgage. You still have this period of time where you haven't paid off your mortgage. You've paid down the balance substantially, but your principal and interest payment, that amount has not changed. Yes, if you look into the principal and interest payment in terms of its application of how much is going towards principal, how much is going towards interest, more of your payment is going towards principal and less of it is going towards interest. So in other words, if I say that you have a $2,300 a month payment and we were to break this down, maybe now you have $1,700 going towards principal and you're talking about $500 going towards interest. But you still are required to pay a $2,300 payment. Except the problem is now what? You're 70 years old, you're 75 years old, you're no longer working, you're on a fixed monthly income, and because of your relationship with the bank and the series of videos that I did with between you, the bank, and the house being a collateral, you signed a promissory note that makes it for you to make mandatory, timely, monthly mortgage payments. And my question to you is that at your age, 70, 75, 80 years old, with another 5, 10, 15 years left of this principal and interest payment, and all of this housing wealth accumulation that you have, why would you want to make a single monthly mortgage payment for another 5, 10, 15 years if you didn't have to? And my contention is that the features and benefits that I just outlined here for you of the reverse mortgage and what it can do for you and how long it can do it for you, and the fact that if you look at over here, the cost is minimal at $22,000 or even less, depending on if your property value is worth less than $1 million. This cost is minimal in relation to the protection that you're getting. The reverse mortgage is your single biggest legal guarantee that the lender can never come and foreclose on you for not having paid a monthly mortgage payment. Now, when we were on the other side of this board and I shared with you that the number of seniors that are delinquent on their mortgage payment and the number of seniors that are facing foreclosure right now, how many of them do you think would gladly have accepted a proposition put in front of them and not be facing foreclosure, not being delinquent, which the next step is foreclosure unless some miracle happens and you're brought current, that if they had a reverse mortgage and could stay in that house for the rest of their life and not worry about a monthly mortgage payment and the loss of a spouse and everything else that goes with it, and they had a reverse mortgage at the cost of having this MIP, whether it's the $1 million and less dollar amount or this $22,000, would have gladly said yes. You could answer that for yourself, but to me it's 100%. 100% that they would have accepted it. The question is, why didn't they? Why wasn't this an option to them? Why wasn't it presented? Because we now know that over $10 trillion of housing wealth accumulation is available to seniors to use. But my contention has been all along that if you think reverse mortgages are the devil's loan, that they're equity strippers, that the bank is going to keep you off title and they're going to own the house, and that the cost is prohibitive, you're never even going to come to the consideration or the conclusion or the realization or a conversation with someone who's educated and licensed and who really cares about your well-being. You don't have to take my word for it. I mean, I just shared with you what this person who didn't even do the mortgage with me said, and the number of seniors that have already in year 2022 have done reverse mortgages is a video that I have, and I would encourage you to watch it, because the question becomes, there's a lot of negative connotations around reverse mortgages, but despite being that, there's so much negative noise around it. There are seniors that are every day accepting the benefits and features of a reverse mortgage, despite the fact that somebody told them this is going to cost $20,000, $22,000 for the mortgage insurance premium. They still did it. And I liken it to an example where, God forbid, somebody's sick and they go to the doctor and the doctor says, you have this ailment, and the cost of the medication is $20,000, and it's going to be something that unless you take it, you're not going to live, and your quality of life is going to be severely affected. Do you think that person who can afford, in the sense that they'll be able to get that $20,000 to pay for the medication, is sitting there saying, I don't know, $20,000 sounds too much to me, I'm not going to get the medication? Absolutely not. To me, this is what that is. It's a bitter pill to swallow. I get it. It's uncomfortable to the idea of $22,000 of my housing equity being depreciated to go towards a mortgage insurance protection. But this mortgage insurance protection is protecting you and is protecting the lender. And the whole reason I kept on going into the analogy of how your current homeowner's insurance is just another form of insurance where you're giving up certain liabilities and buying protection, is because this is exactly that same situation. And the fact that your housing wealth is paying for it and it's not coming out of your pocket should give you even more of a confidence, more of a comfort, because it's not literally coming out of your bank account. And if you think about the idea that we've been referring to, and I keep on saying that 2008, 2009, this housing wealth appreciation has absolutely nothing to do with your mortgage payments, with your ability to continue making mortgage payments. The housing wealth appreciation or depreciation is going to do what it's going to do. The only thing that you're going to have in terms of protection against this depreciation of housing wealth is if you can stay in the game long enough for this downturn to become an upturn. That's your only protection. In other words, if you think about all the downturns that you've been in real estate, the only way that it worked itself out is that you continued staying in the house, you continued making monthly mortgage payments, and over time this downturn became up and became an appreciation. And all the reverse mortgage is guaranteeing you is the following. We're going to guarantee you that you can stay in the game long enough for this to take place. We're going to let you stay there long enough so that the lender doesn't come and foreclose on you because of what? Your promissory note, your obligation to the lender to have to make monthly mortgage payments. And that's why we say, if you're in this situation where you've got 10 more years left before your mortgage payment is fully paid off till you reach zero, are you in a financial position at 70, 75, 80 years old to keep paying this monthly mortgage payment? An impolite way of saying it is, do you want to continue making monthly mortgage payments for your inheritance to have less of a balance so that whoever gets this property and a week later after your funeral has it listed and up for sale, they get more money? And I'm sorry to say it like that, but in another video I referred to, at this point you're old enough to have seen your contemporaries, your friends and family members and associates that you know that have passed away, and what happened to their home. Did any of the kids run into the parents' home and say, we're going to stay here? Or how quickly was there a for sale sign listed on the front door, and then the property was sold and the money was divided and then everybody went their separate ways. So if your game plan is to continue making monthly mortgage payments to get to zero at the cost and the suffering of being potentially, God forbid, one of these numbers, one of these seniors, which if you watch the videos that I did with the Consumer Financial Protection Bureau, I broke down the numbers and I went deep in the weeds where some of these seniors, at the cost of making their monthly mortgage payment, don't have the ability to pay for food, don't have the ability to pay for other expenses, don't have the money to make ends meet. And that's why I said every single one of these people that could have qualified for a reverse mortgage, if they knew that they were going to be facing foreclosure or in this situation, I have no doubt in my mind that they would have. So to me, if it's between facing foreclosure or being delinquent on my mortgage payment, or even having to pay for another, 10 years, another 5 years of a monthly mortgage payment that's mandatory, or a scenario where I could be in my own house, aging in place, and not worrying about a required monthly mortgage payment, plus all the features and benefits that I already went over the reverse mortgage with, there's absolutely no question. And this $22,000 is not even a consideration. So I tried to approach it from every perspective that I could, and make you think of it in what I think is relevant. How old are you now? How many years do you have left that you could age in place in this house? How comfortable are you at this monthly payment arrangement? What is it doing in terms of this payment going out of your pocket and not being in your pocket to be able to do other things? Because if you look at this list of features and benefits that I have out, and this is not even the entire list. I'm going to have another host of videos where I've been referring to making a bridge, coming from walking, I call it the bridge to freedom and financial independence and dignity, but I'm going to do that as a next video. But I have probably another 10, 15 benefits that I haven't even listed here that come along with getting the mortgage insurance. The mortgage insurance is the backbone and the reason the lender even does a reverse mortgage. But its meaning to you, your focus, your attention, your benefit is these things plus all the other ones. If you just think about the fact that automatically you eliminate the risk factor of a foreclosure for non-payment of a mortgage for the next 10 years, that is huge. And if your property value is $600,000, $700,000, and you're talking about 2% of that to get the initial upfront insurance, and that's $12,000, $14,000, that's nothing. Look at how many years. Here's a perfect example. I promised to be drinking while we did the last video, so let me take a little drink here. I'll say this and I'll close it off, but let me leave you with this. Take your yearly required homeowner's insurance, $1,200, $1,500, whatever it is. Multiply it by how many years you've had it, 20, 30, 40 years. You've put out in your homeownership insurance premiums $30,000, $40,000 and up. Now, thankfully, if I said to you, how many times has your house burned down? You'll say never. How many times have you had it destroyed where the insurance had to step in and make whole for you and the lender? You'll say never. That's money out of pocket that you paid to pay for insurance that you never benefited from. This is actual insurance where you are going to benefit from it. You are going to benefit from it just by the virtue of the fact that over the next 10 years, what is the likelihood of property values depreciating? They're great, because now we're in a situation where in an 8% inflation, interest rates are at 8%, housing values are going down. And if I said to you, your property that was worth $1 million, can you afford to lose 20 to 30%, which is automatically $300,000? Well, hell, the $300,000 that you're going to lose in your property value decline is significantly more than the $22,000 we're quibbling about. Here we're talking about, it's like walk over $1 to pick up a penny. We're stuck on the $22,000. I'm not stuck. My clients are stuck on the $22,000. But meanwhile, if your property value goes down 20%, that's $200,000 that your property depreciated. And it could take 5-6 years before this comes up. If it goes down 30%, now it's $300,000. Okay? And your only oxygen is to sustain yourself in the property here and be able to stay here. And your best bet of staying here and waiting for this thing come up is not to have to make a monthly payment. Because if you have to make a monthly payment and you run out of money, you're no different than these poor people that did the same exact thing. None of these people woke up and said, I'm not going to make a monthly mortgage payment because I want to go see what happens and what the consequences are. They didn't make a monthly mortgage payment because they ran out of money. They ran out of money because they couldn't make the monthly mortgage payment. Those things go hand in hand. But once we get you into a reverse mortgage, it doesn't matter how old you are. You could be 70 years old and live in this house for another 15 years. Don't make a monthly mortgage payment. I mean, I don't know how else to do it. I really don't know. If I didn't cover some aspect of it and you guys are stuck on that aspect of it and I haven't done it, let me know. But I think I got excited enough for tonight. All right, so at this point, I rolled out everything that I could come up with as far as the initial cost conversation that we're talking about in the series of videos that I've done. And like I said, each one of these videos, I'm going to go back, I'm going to unpack, I'm going to make smaller videos more specific to each topic that I think needs more of an attention. But you could see now why this video around the cost aspect of it had to be broken down and be its own video. Because if I was going to include this with other videos, it would have been 5 hours and all of you guys would have been asleep. All right, so I want to thank this gentleman for his very kind words. Mr. Ronald, thank you. God bless you. I appreciate it. I appreciate the encouragement. I appreciate the positive feedback. These videos are a labor of love for me. I mean, if you think about, we have 10,000 seniors turning 62 and above every day, and the amount of housing wealth that there is and the amount of good that can come from this and the amount of financial freedom and financial independence and the level of dignity that you can have. I don't mean to be insulting you when I say that, look, if you choose to make a monthly mortgage payment for the next 10 years, it's at the cost of you paying down what other people are going to inherit and turn around and sell. I don't mean to be insulting you, and if you are, I'm sorry about that. But that's the reality of the situation, because if you talk to your contemporaries and say, what happened to the Miller's home when they passed away, they'll tell you that they put it up for sale and within a week it was sold and the kids took the money and that was that. Well, the Millers continued making payments till the end. Did they have any financial freedom and independence and dignity? All right, I'll get off my soapbox. God bless you. Thank you. Thank you for being my client. Thank you for giving me the opportunity to share these videos with you. I hope it makes a difference. What's the old saying? I yell because I care. I'm passionate about this thing that I do, and I'm very blessed to be able to do it, and I hope it makes a difference for you, and I hope it's able to answer the questions that made you not consider doing a reverse mortgage up to this point. And if it did, and if it helped one person, then I'm thrilled. I'll see you in the next video. God bless you. Thank you very much, and have a blessed night.